Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a 1-year daily candle chart of the Qs, which is basically the Nasdaq market ETF, ticker symbol QQQ. But before I get into my market forecast, I'd like to briefly explain to you that I am in the middle of an evacuation plan, because you can see right here we have Hurricane Dorian, and it is on track to hit us directly. I'm sitting right here, right there, right where that dot is, and so we're managing our risk on another level. Some of you have heard my reports in the past where I refer to my ability to forecast the weather. Well, that's because my degree is in aerospace engineering, and a big part of that degree involves weather and weather forecasting, because obviously as a pilot you have to know what the weather conditions are before you take off the ground, and you have to be able to manage risk. So I hope you appreciate the fact that we are still getting this out under the threat of a possible Cat 4 hurricane, and while that sounds exciting, it truly is a serious matter when it comes to managing risk. And so with that, I'd like to turn our attention back to the Qs. Last week's forecast, left my lines on there. I said that we would most likely drop before going higher, with the end of my line right there being my target level. And you can see that we have already hit the target level. We did that yesterday, which was the 29th of August. And in moving higher, the market gapped up. Now, what does that mean? Well, again, if you've been following along with the Market Guys series, you'll know that gap trading is actually one of our favorite strategies, because there's certain rules that you can apply to gap trading, one of which is 80% of the time after a gap forms, what happens? The gap fills. Then after the gap fills, there's another 80% of the time that the stock will reverse from that point. So now that we've hit our target on the Qs, I'm going to erase all of these lines so that we can draw the lines for next week's forecast. And again, here is the gap. I'm just going to highlight that with the magnifying glass. The gap fill point will be right there, so I'm going to mark that as our support level. Why? Because again, there's an 80% chance that the market will pull back to fill this gap, and then after the gap fills, there's an 80% chance that it will bounce. Now, one other point I'd like to make is that Monday for Labor Day, the markets will be closed. Sunday evening, the tariffs that the U.S. is putting on China are going to start to kick in, and the tariffs that China has put on U.S. goods coming into their country will kick in. So anything could happen on Monday and or Tuesday. So we have to be very much aware of that the markets are being driven by the good and bad news of the trade war between the U.S. and China. So it's very hard to forecast what's going to happen or what's coming out of Washington or China for that matter. But the fact is that the technical signals are telling us there's an 80% chance the market could pull back next week. Now, in addition to that, notice what's happening here. We have a resistance point that I'm going to draw from this high right there, connecting to this high right there from the 22nd of August, and projecting out. So once the market starts moving back up to that resistance level, we'll have to keep an eye on the volume, because if the volume starts to drop as the stock is approaching resistance, there's a good chance it could pull back. So let's take this one day at a time, 1 week at a time, and right now we're expecting a pullback. All right, now let's go right to the VIX, because I want to start with that. That's a contrarian indicator. I said that the VIX would most likely go up and then pull back from resistance. It did not do that, but I do think it will eventually do that, possibly next week or the week after. So I'm going to simply move that on over to the right. I'm going to take this line and remove that, and then I'm going to draw it to the right. So this is a bullish engulfing pattern on the VIX. So I think next week we could see a higher VIX. Now remember, the VIX is inversely related to the S&P. So if the VIX is expected to go higher next week, we would expect the S&P to drop. So let me do my forecast right there. Support held, like I said, we most likely will. I'm going to erase all these lines and redraw the lines for you on the S&P as well. Remember, the VIX is bullish, so we're expecting the S&P to go down. Let me zoom in to give you a better picture of that. Again, here is a gap. Here is support that we expect to hold. I think that the S&P will pull back to the gap fill point and then eventually bounce, just like that. So that's my forecast for the S&P. If we look at a more broad-based index in the Russell 2000, my forecast from last week was that we would go down below support, and look at what happened right here on the 27th of August. We had a bearish engulfing pattern that resulted in a slight breach or breakout below that moving average. I can't even call that a breakout because it's just like a little bit of a violation of that support level, and then it bounced. I think that that will hold, but watch as I erase all these lines. I'm going to keep this support level in place just like that and then zoom in. The Russell 2000 is a more broad-based index. There is a slight gap right there, and I think that that gap will fill. So next week, either Tuesday, Wednesday, Thursday, I think we're going to pull back to the gap and see a slight bounce. So that's my forecast. Keep that in place. Again, I keep the lines on the chart each and every week so you can see how the forecast panned out, and you can see with your own eyes the evidence as to how accurate technical analysis is as a forecasting tool. Going to the diamonds, what did we say? We said that we'd pull back early in the week and then rally. We did that. Monday and Tuesday we had lower lows, and then Wednesday we showed a bullish engulfing pattern, a gap higher on Thursday. Friday we closed with a red candle. Again, erasing all these lines so you can see exactly what we're doing here. The gap is below the market. I think we will pull back to fill that gap. That gap, by the way, also coincides with the 20-period moving average. So I think we're going to pull back at least to fill that gap. There's also an area of resistance right here that I will draw. Again, holding because it didn't close over resistance. It traded over resistance but didn't close over it. And you can see down below the CCI, which is a leading indicator. It even leads the stochastics right here. Stochastics is showing overbought. CCI is showing overbought, but the CCI is now starting to hinge and move lower. A hinge is more or less that little tick down or sideways right here. Let me zoom in for you so you can see that. The upward momentum of the CCI crossed over the overbought area, which is that horizontal plus 100 red line right there, and then it started to move sideways. If you have never followed the CCI before, I think this is a good time to do that because it is very sensitive to turnaround or pivot points. I think that could be a very good tool for you. So that's our weekly market report. Please wish us all in Florida good luck, and hopefully we will not have to suffer any pain or damage from this storm. You can see, look at that, the eye wall is really starting to form and it is intensifying. So again, have a great long weekend for those of you that are out of the eye of this storm, and we'll talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.